When we talk to our investors, we ask them, would you like to be able to have upside, or do you want something that's more guaranteed? Because people are in this more fear mindset right now, they want that guaranteed return.
Hi, everyone. Welcome to this episode of the Immigrant Doctor Podcast. I wanted to discuss a very interesting topic, another way for people to invest passively in, and these are called debt funds. And when I was researching this topic, I was wondering who I should get on my podcast to discuss this. I came across Erin Hudson. She's actually a part of the same mastermind that I am a part of, and we really connected and jived. And I think it's going to be a fun discussion that we're going to have together. It's just briefly about her. She's a chiropractor by profession, and she had a very successful practice. She had multiple offices, but she transitioned to real estate, and she's actually quit being a chiropractor now. So I'm going to dive into this a little bit, into her journey. I'm going to let her talk about her story and how she got started in this before we start talking about debt funds and how to invest in that. So welcome, Erin. It's so great to have you on my show today.
Awesome. It is an absolute pleasure and a delight to be here. I hope to drop some great nuggets for your listeners today. So I'll start in and just share a little bit about myself. As he already said, I came from being a doctor of chiropractic, had a couple wellness centers in Southern California, and I'm just going to get straight to it. Being in private practice was an absolute dream. It was awesome. I had 30 team members that were in my practice. But here was the problem. The problem was in these two practices doing very well, but paying a heck of a lot in taxes, like close to almost 50% in taxes as a business owner. And so, of course, when I found out about real estate, it was a look no further, because I was told that basically you could pay little to no taxes being a part of the multifamily and real estate space. And so that's really what got me excited. But over and beyond that, there was something even just a little bit more. And it was my kids. I have 5 kids. And let's just say I grew up in a home where my parents were busy building somebody else's dream. I can't be alone here, but basically, just to sum it up, I was not fed with a silver spoon. And so when I found out about the goodness of real estate, all I could think about was this. The likelihood of my kids becoming doctors was minute, but the likelihood of me being able to educate, equip them, and show them how to become a passive investor, how to make money while they sleep, let's just say I was on fire for exactly that. And that's exactly what I've done. I left practice and I jumped right into the real estate space and single family initially. And then I found out the power and the goodness of multifamily. And let's just say the party was over. So that's really, in a nutshell, where I came from and how I transitioned and moved over to multifamily.
Erin, when we say go to school for whatever whatever profession we're going to take on, we learn about it very well, right? But that's not necessarily the case with real estate investing per se. I think it becomes a little more challenging. At least I can speak for myself. I've been in schooling for a very long time, but nowhere along the journey did I learn how to invest money. So what made you what got you into this education, and how did you kind of learn about investing in real estate?
Yeah, that's a great question. I would tell you this much. If you want to know the true breakdown, it really started with me being in practice. I had my sweet 14-year-old daughter who was the receptionist in one of my wellness centers. And I heard a gentleman out in the reception area just telling about, my daughter had actually inquired and said, "Hey, how's your day going?" And of course he shared, "I'm excited. I just got some new mailbox money." And I remember hearing that from the other room, and he was basically talking about how he had bought another single family rental property, and the mailbox money was those monthly checks coming in to his mailbox. And so let's just say when he got into the office and I got a chance to say, "Hey, I overheard you talking about the celebration of your mailbox money. Would you mind sharing a little bit more?" And he ended up sharing, and let's just say that I'm very much a doer and not a sitter. And I just decided that I wanted to jump in as well and find out how I could start to acquire single family properties. And so it was very quickly that I got in the game. I'll spare you all the details maybe for another time. But within 2 years, I had acquired 26 rental properties. in a creative acquisition manner. And I guess we can just kind of sum it up and spare the details. But basically, I would buy homes. I would buy like a 3-pack of single family homes, not in California where I lived because the housing prices were ridiculous, but I would buy them in Indiana. And of those 3 homes, I would increase the price on 2 of them that ended up actually being the full cost for the 3. And so I would keep 1 for free. I sold off the 2, kept 1 for free, and I would rinse and repeat. And yes, I had money to buy some myself, but I also was getting those freebies. And so that's how I had acquired the 26 rental properties. And then from there, yes, I got a taste of my mailbox money. But then
that's amazing. Yeah, that's amazing. But I'm sure, this must have had its own challenges, like managing 26 properties firstly, and the way you were doing it, single family, buying 3 properties. It's like a constant to me, it almost seems like you were replacing one job for another job. What were the challenges that you faced when you were doing this, and what made you kind of transition to now larger multifamily and then now into debt funds?
Yeah, so listen, I'll be completely honest about that. I was not managing my own properties. I had my own property manager. I had construction, rehab, put lipstick on a pig type crew that would help me on that front. And so, yes, it was really more or less oversight of the P&Ls coming in and the payouts and so on and so forth with the checks and balances on that part. And then in all fairness, I had my whole staff that was in my wellness center. So there was a lot of crossover, and my assistants were helping me with making sure those rents and everything were coming in and being accounted for correctly. So there was a lot of help that was coming out, that was happening from my team that I had. With that being said, as far as challenges, the scalability wasn't there. So, and also think about it this way. If a tenant moves out of your house, not for me because I didn't have a mortgage on it, but most people, you still have to pay the mortgage, right? Or if a tenant moves out, you still got to go in and you got to paint the walls and put in new carpet and etc. So if you have one house and you lose 10%, really in essence, you've lost your income flow that's coming in. But if you buy a 100-unit apartment building and you lose 10% of your tenants, you still have 90 of those apartments that are bringing in cash flow. So it was really easy to understand the power of scale when you moved into the multifamily space. It was kind of a no-brainer.
So what's causing you to now move towards debt funds?
Yeah, so I think this, look, with our team, we currently have got just under 200 million assets under management. We've raised $80 million. But here's what happens when you have, like in 2021, we took down 17 apartment buildings. So we were on the go, constantly raising money. Well, we all know what's happened in the market right now. Everything's kind of ceased up. The interest rates have gone high. Our debts we're having to pay more monthly for our apartment buildings in most cases. And furthermore, we're just not making as massive moves in such rapid fashion because there's been a slowdown. But what I will tell you is this: we are getting ready to have massive momentum that's about to happen in the next 24 months. There's going to be a lot of opportunity. Why? Because there's so much fallout of operators that are in a really bad position because cost of goods went up, therefore they couldn't afford to do their full renovations on their units. Then you double down on that with interest rates going up and not being able to service the debt. So you've got this deadly combination where people don't have a choice. They're going to have to sell or else they're going to end up losing their property. So that's really where Quattro Capital is going to lean in, and we're looking to pick up some pretty great assets. So why funds, you ask? Such a great question. I just told you that we were picking up in a mighty way in 2021. There's been a slowdown, but we're just getting ready to pick up this massive momentum. So think about it for a second. If I can bring in other fund managers that also have their own fund, and let's just call it, if I had 10 of them and they each bring $1 million from their fund, they can come in and invest in our property. And if they come in and invest in our property, I just said 10 people, $1 million each, that's $10 million. If the raise is 20 million, I already got half my raise completed for this first property. So why do I want fund managers? Because it's going to allow me to have powder to pick up the momentum, pick up assets, and really win over this 2-year time frame. Does that make sense?
No, it absolutely makes sense. But but that would probably be when we're talking about getting in fund managers. That would probably mean somebody who's coming in with the equity. But I'm talking about in terms of giving an option to passive investors. How would they benefit from debt funds? Actually, let's step back a little bit. Let's just talk about what exactly debt funds are, because I think it's a relatively, at least it was a relatively new concept for me. So I think it would be beneficial to kind of uncover the whole mystery about it and see. Basically explain what a debt fund actually is and what it actually does.
So I just got finished explaining to you just the fund and why funds are so powerful and will be for Quattro. In addition to a fund that's buying a apartment building, when we have the fund, it allows for our investors to have upside from the equity that they've put into the apartment building. And then there's this grandiose at time of exit, right? Where they make an incredible return. Well, in addition to that, Quattro has also created our debt fund. So I want you to imagine for a second with the debt fund, right now what we're giving to our investors is an 8% guaranteed quarterly payout. Their money starts to accrue right away as soon as they put their money at play. And it's a 3-year hold. Whereas when we go back and we look at the other fund that's buying apartment buildings, that's a 5-year hold. And in all truthfulness, there's not a payout until usually the 2nd year. Because in the regular fund, we've got to come in, we've got to increase the income and the rents, we got to decrease the expenses and increase that bottom line. Whereas the debt fund, you're putting in your money, you're getting an 8% guaranteed return, and people want to have their money preserved, protected, and they want to know that they're going to have a guaranteed payout. And so, furthermore, when we talk to our investors, we ask them, would you like to be able to have upside, or do you want something that's more guaranteed? Because people are in this more fear mindset right now, they want that guaranteed return. And a lot of them, believe it or not, have lost money in the stock market. So if they can come and they know that they're going to get an 8% guaranteed return, it's a no-brainer. So that's the basics of it. Now let's talk about, would you like me to go and share why that can be really powerful for an operator? Is that what you're wanting to do?
Well, I think more from the point of view of an investor, and basically kind of I want to understand, because like we always talk about investment, and we know that whenever we talk about investment, we say nothing is guaranteed, right? But here you're saying that it's a guaranteed 8% return, and I would be very curious, and I'm sure my listeners would be very curious to know how you're guaranteeing that 8%. And where is that money actually? What is that money giving a loan against? Because it's essentially a debt fund, right?
And you can call it, actually, it's like a promissory note, in all fairness. You don't have to discuss with your investors where that money is going and what it's tied to. It could be a plethora of different things.
Sure.
It could be so that you have powder to be able to make moves and buy and pick up these opportunities. It could be a gap filler. Probably many of you know right now that when the banks seized up, all of a sudden those that had CapEx projects for their apartment buildings that needed to be done, the banks were slow to start giving those funds so that they could continue with their rehab and their renovations, right? And so it can also be used as a filler to come in and allow those renovations to continue on while maybe perhaps an operator is waiting for the banks to give funds to continue. It allows them to create that forward movement without a stall on their business plan. So it could be to put earnest money down on a potential property that they're getting ready to buy. Okay, so those are some of the things that it's used for. Now you ask, how can your investors feel confident and comfortable? Well, for us, I'll use Quattro for example. We own a handful of apartment buildings that are owned just with Quattro. We don't have any other investors. We call those our legacy properties. And so God forbid if we defaulted on, call it the debt fund there, that it would be backed. The collateral is our apartment buildings that our ownership piece. And so if we had to sell them and get cash out and make our people whole, then fantastic. We're in that position to be able to do that. Not everybody is, right?
Right. No, it's amazing.
You need to understand too that you cannot be in first position to an apartment building that the team purchases. it's not allowed, right? The lenders would never allow that. So you just want to be very, very clear about that. And truthfully speaking, also in addition, really those investors that are going to come and join forces with you on per se the debt fund, there's going to be a know, like, and trust factor. If they don't know you, like you, or trust you, they're certainly not going to put their money with you. So where we've had really great success is, guess what? We've already purchased 27 apartment buildings as Team Quattro. So many of those investors have already worked with us. They know our track record. They know how we operate. They know we're about impact, and we're call it the real deal, right? And so once they've been an investor with us, there's already that trust factor there. And so it makes it much easier for them to want to join forces and be a part of our debt fund.
Right. No, that makes so much more sense, that it's backed by the properties that you guys already own. I'm just curious, what would be an ideal investor for your debt fund?
An ideal investor is somebody that is, there's a couple different avatars for this. So for the debt fund, if somebody is coming from the stock market and they've been at a 33% loss, which is a lot of people, it's like Rochambeau. Like, do you keep your money in the stock market and hope it doesn't go any lower, or do you preserve and protect what you have? So because a lot of people have been in that loss position, they're a little bit nervous to put maybe perhaps into a multifamily because it's not guaranteed. People love the fact that it is a guaranteed 8% return. What I will tell you is those that need cash flow, also this is a great one, because if they're putting $1 million in on that, right, and they're making a nice good monthly payment from that $1 million that they put in the guaranteed return, it's able to take care of their annual expenses for living. So somebody that's a little bit older really loves that. Then you've also got individuals that people love options. So when I explain, would you like to be a part of something that has upside, or would you like to have a guaranteed return? Well, Aaron, I kind of like the idea of both. What if can I do both? Well, absolutely. So if someone brings in 300 and they say, look, I just want to split it half and half and be able to have the upside, but also the guarantee, that's fantastic. We're able to solve that for them and give them options so they don't have all their money in one basket.
All right, guys, if you haven't done already, please go check out my free video series on how to do due diligence on operators and on deals before investing in them. It's called Real Estate RX for Passive Investors, and it's available at www.rerxcourse.com. Right. And so what would be the sort of the pros and the cons of having investments in a debt fund versus, directly investing in real estate or directly investing in syndications?
Sure. So they're not going to get that equity upside, right? So when we go to sell it, they're not going to get a piece of the pie on the additional proceeds that we were able to create from the investment, right? They would get that. Also, they would be getting their payout 3 months after they invest their money, whereas the other one's not going to be until the second year. In a debt fund, it's 3 years minimum and 5 years maximum. I will share another thing that's really, really powerful. I would say probably about 40% of our investors are investing in the multifamily space with their IRA. With your IRA, I don't want to get too lost in the sauce with it, but you do not get any depreciation if you use your K1 to invest. There's no paper loss. And just so that our listeners can understand, for the most part, you can plan if you invest $100,000 into an apartment building that you're going to get roughly about 50% loss on a K1 as a paper loss to go against your earnings in due time. Okay? Now, with that being said, if you're using your IRA, there is no paper loss. So if there's no paper loss, check this out. It may make sense to go with that 8% guaranteed return using your IRA because you're not going to get any paper loss anyways. So this is part of the strategy that I walk through with my doctors, with my attorneys, with our investors, and I say, hold on a second. Let's talk about what are your goals for this year? How much money are you looking to invest? If you could double your money every 5 years, how much would you want to deploy annually? Okay. Then I also say, how much of that would you like to be investing with your IRA? Are you in that position to invest with your IRA? I like to have a full picture. It's not to be nosy. It's to best help them and give some thoughts and ideas as to what might make the most sense for them. And so I treat every investor as if they're like my brother or my sister, and I help them walk through. And then from there, they decide what they want to do. But we have a lot of investors investing with their IRA money, because check this out. In addition, in that debt fund, if they opt for compounding their money and they don't want to have a payouts quarterly, they can let that compound. And then hold on, if they want to stay in for the 4th year, then they get not 8% earning power, they get 8.25 earning power. And then if they want to stay in the 5th year, then they get another additional 0.25. But hold on a second. I feel like QVC, like the Home Shopping Network. If they're using their IRA and they're under 59, they can't spend that money that comes in anyways. So why not compound it? Don't take the quarterly payouts and allow your money to grow even more, right? So there you have it. I'll pause for you to ask any additional questions.
No, that's amazing. I think that's a great opportunity for especially with for people, especially with their IRAs, because you're right, you cannot take that money out. And I think also the fact that you mentioned that you have to talk to your potential investors and see what's the right fit for them. I don't think it's one size fits all for everybody, but I think everybody has a unique situation, and understanding that for us as operators is very important, so that we can best help them, with their needs specifically. Specifically with respect to the debt fund that you're into, how are you planning to source deals for it or evaluate potential investment opportunities for this?
Yeah, so listen, I will say, because we've closed on 27 apartment buildings, we're kind of in the forefront with a lot of brokers. Why? Because they know that Team Quattro does not start something and not finish it. We've always taken a deal that we went under contract on, and we've taken it across the finish line. As much as multifamily is a big space, it's really, really finite to those that are really making massive moves in this space. And so when you have a good reputation goes a long way. Not only is it the brokers, but it's also the lenders. They know who the top-notch operators are. And then I'll tell you this much. When you get clout, such as your property management company wants to invest with you, when you get your brokers that want to invest with you, and that is a big deal. Why? Because property managers see the ins and the outs of everything that goes on in your company. And guess what? I would probably say 99% of their operators, they would never invest with. So it's an absolute honor when our property managers are saying, hey, I want to work with you guys. I want to invest with your team. That's powerful. And same thing with the brokers. When the brokers want to jump in the deal and give a portion of their commission so that they can invest in the deal, that's an absolute honor as well. It tells us that we're doing something right.
Absolutely. I think that makes so much sense, because, it's very important for us to work as, good operators. And the fact that people who are actually on the ground, like the property managers, the brokers, if they're willing to partner with us on our deals as investors, I think that certainly gives us a lot more confidence, because they are actually interacting not just with us, with a whole lot of other investors. And for them to kind of invest money with one particular person certainly is rewarding in itself.
Yes, no, absolutely. It's been super fun. It's great to be able to impact people's financial future for the good, right? And when you have, like for us, it really helps because we have a track record. We sold 5 properties last year, and every single one of those properties netted our investors over a 30% return annually. That's a big deal. You have to have a proven track record in order for people to want to get on board with you and do business. So it's such an honor and a blessing that we've had such great results with being able to walk out and execute on our business plans the way that we have and come out on the other side across the finish line, helping our investors win and duplicate, have their money make babies is what I like to say. Yeah.
That's a nice way to put it. But Erin, since we are in these economic times, the economy the way it is right now, It's not a very conducive environment right now for business. And, of course, people are fearful about investing their money. How do you see the performance of a debt fund in these times, in these difficult times, and how do you propose to navigate this phase of the economic cycle through this debt fund?
Yeah, well, let's just say this much. I think that if we all go back to, what was it, in the 1980s? Interest rates were like 18%. And guess what? People were still doing deals at that time. So just because the interest rates have gone up, it doesn't mean that we're going to freak out, sit on the sidelines and say, oh, forget it, I'm throwing in the towel, I'm not going to play. Not at all. You have to be able to pencil the deal, and if you can make it hum, fantastic. The problem that we have right now is that those interest rates aren't stabilized. They're constantly moving. We don't have a crystal ball to tell us where they're going. And then in addition, the purchase prices, we don't, it's hard to say because of the cap rates. The cap rates are changing too. So I guess the biggest thing is you don't want to, as a buyer, come in and overpay for something right now. We've got to wait for things to settle just a little bit. So we've most certainly got our pulse on some things. We're looking at deals, but I'm telling you what we could have bought, what was it? I don't know, call it a $14 million deal, lost $1.5 million from what it was a year ago to now as far as purchasing. So you don't want to be too premature and buy something that in a year it's the same price than what you paid. Our whole goal is to increase the income, decrease the expenses, and make that bottom line look really shiny and pretty to be able to resell it. So we just have to be very, very careful. Now, with that said, in regards to the debt fund, what was your question? Let me just make sure I'm specific with it.
Well, I mean, in terms of the changing economic times, right, it's become a little more difficult generally for everybody to do business. And we're seeing there's a lot of fear in the market, right? So how is this debt fund sort of positioned in this phase of the economic cycle to kind of navigate these difficult times? Basically that was a question that I wanted to ask.
Yeah. Thank you. So I think that it is super, super important to make sure that you're buying properly. It's not about getting tantalized by a beautiful property. What is more important is the metrics and where you're buying. Meaning, are we going to go into downtown Houston by the Galleria? Probably not. We like to go on the outskirts of those type of areas where we know that that's where it's pushing out to and that's where the growth is. Because if you can buy in an area where it's trending far better than the US when it comes to occupancy rates, rent growth, what are the employers that are coming in? Is there a lot of that? And income is trending and more favorable, moving in the right direction, and rent is increasing. You want to make sure all of those are a little bit more favorable, more and better than the average US, right? The way it's trending. Because if we buy and we're looking at those type of metrics, that's going to allow for us to have the natural appreciation. And you mix that with the forced appreciation of going and making sure you're vetting out an area where those comparables, we know that we can come in and raise rents. When we have that forced appreciation and then you mix it with the natural appreciation, you get to ride the wave of this, like the value just goes up, right? So if you're really monitoring those things and you're purchasing smart, you can't help but to lose. And if it's with think about it this way, if it's with a fund and you're guaranteeing an 8%, my goodness, if you're not making 20% on your money at the end of 5 years annually, then you've got a little bit of a problem. There's a little bit of a problem there. You didn't do enough of your research, right? We want to make sure it's going to be trending in the right direction. And at the end of the day, it's all about the arbitrage. 20% minus that 8% of what we have to pay our investors. Now we're gaining 12% with another's money. You see what I'm saying? So 8% is a metric that I think shouldn't have an issue being able to hit that.
Yeah, and I think some things that you mentioned were that, like, for example, you're not going to buy in downtown Houston. I think it's also about how you're buying it and buying the asset right. So regardless of the economic cycle, regardless of whatever it's doing, if you're making, projecting certain returns on certain, with your fund, you got to make sure that you have an in-depth knowledge of the local forces at play, of the local market where you're buying, so that regardless of what the economic cycle does, you're still positioned well for that particular asset to make money for you and for your investors.
Yep, that's exactly it. You've got it right. You just got to be smart about your buying and make sure that those numbers be super, super conservative on your occupancy rates, be super conservative on what your interest rate is. All of those things really matter. And if you're super conservative on your rent bumps, sometimes I work with investors and all of a sudden they think that they can get much higher per door and attain it very, very quick. When you start to do that, you set yourself up for failure if it is not something that's attainable. So that's what I'm talking about when I say be uber conservative, worst case scenario. With our 5 exits that we had last year, we said an 18 to 20% return. How is it that we were able to hit over 30% on every single one of these assets? Because we were conservative, like what I just talked about. When you're conservative, in the back of your head, you're going, man, we're going to knock this puppy out of the park. And when you do, man, it's an absolute win for everybody. And the last thing you want to do is go sideways with your investors, because you have one shot to make sure that you take care of them very, very well. And if you do, the trust is built and they are never going to leave you.